Hey everyone, welcome back to Corporate Decoder, where we decode the secrets behind financial reports and give you the real story. Are these numbers as rosy as Jack Henry wants you to believe, or is there a hidden story beneath the surface? Let us dive into Jack Henry and Associates in Corporate's latest 10Q report. This is a financial snapshot for the period ending the 31st of December 2025, and it tells us a lot about where this financial technology company is headed. If you are looking for deep insights into how a big company makes its money and what challenges it faces, stick around. And before we get too deep, if you enjoyed cutting through the corporate jargon to get to the truth, hit that subscribe button now. Also, come join our growing community on Discord, linked in the description below. So, what is Jack Henry all about? In simple terms, they are a big player in the financial technology world. They provide a whole range of services to banks and credit unions, like processing transactions, managing customer information, and offering all sorts of software. They have been around for a long time, since 1976, and they serve a huge number of clients, around 7,400. That is a lot of financial institutions relying on them. Now let us look at the money. The balance sheet tells us what the company owns and owes. As of the 31st of December 2025, Jack Henry had total assets of over $3 billion. That is a massive amount. But what is interesting is to see how these assets are distributed. They have a substantial amount in intellectual property like computer software and goodwill, which is the value of the company beyond its physical assets. This tells us that a big part of their value comes from their technology and brand. On the other side of the balance sheet, we see their liabilities and stockholders' equity. They have about $857 million in liabilities. That includes things like accounts payable and deferred revenues, which is money they received for services they have not yet provided. And then there is their stockholders' equity, which is essentially the owner's stake in the company. A little over $2.2 billion. This all adds up to over $3 billion in total liabilities and equity, matching their total assets. For now, it seems like the company is in a stable financial position. Let us talk about how much money they are actually making. This income statement is for the 3 and 6 month periods ending the 31st of December 2025. For the 3 months, their revenue was a little over $619 million. That is a significant amount of money coming in. What is even better is that their net income for that quarter was about $124.6 million. That means after all their costs and expenses. They walked away with a very healthy profit. Looking at the 6 month period, their revenue was about $1.26 billion, and their net income was around $268.6 million. These are really strong numbers showing consistent profitability. It looks like the company is growing and performing well financially. And for investors, this translates to good news. Basic earnings per S-share for the 3 months was $1.73, and for the 6 month it was $3.71. This means for every share of stock owned, the company generated that much profit. Diluted earnings per S-share, which accounts for potential future share dilution, also remained strong at $1.72 and $3.7 respectively. Now, let us consider how the company is managing its finances. The equity statement shows us how the owner's stake changes over time. We see that they issue stock for things like employee stock options and plans. They also have a share repurchase program, where they buy back their own stock. This can be a sign of confidence in the company's future and a way to return value to shareholders. The numbers show they repurchased over 406,000 shares in the last quarter of 2025. This is a significant amount, and it shows they are actively managing their share count. Diving into cash flow tells us if the company is actually generating cash from its operations, and it is here we see a very positive picture. For the 6 months ending the 31st of December 2025, their net cash from operating activities was over $273 million. This is cash generated from their core business, and it is a healthy increase from the previous year. This cash is then used for various things. They are investing in the business, paying down debt, and returning money to shareholders through dividends and share buybacks. The company is making strategic investments in acquisitions and capital expenditures for new software and facilities. For instance, they acquired Victor Technologies Incorporated for over $42 million in September 2025. This acquisition likely aims to expand their payment processing capabilities, which is a growing area in financial technology. In their financing activities, we see they borrowed some money on their credit facilities, but also repaid a significant amount. This suggests they are managing their debt levels prudently. Digging into the notes, we find more specifics. They explain how they account for revenues, like their cloud services, and on-premise solutions. They also talk about their allowance for credit losses, which is basically a provision for any money they might not collect from customers. This shows they are being realistic about potential risks. Let us look at the revenue breakdown. It is split into categories like private and public cloud, product delivery and services, on-premise support, services and support, and processing. The private and public cloud revenue is about $202.7 million for the quarter, showing strong demand for their cloud-based solutions. Processing revenue is also substantial at over $273 million. This shows they are a diversified company with multiple revenue streams. This diverse revenue streams is a strength. It means they are not putting all their eggs in one basket. If one area slows down, others can help pick up the slack. This section confirms that their revenue recognition policies are in line with accounting standards, which is good to see. They are being transparent about when they record income. They also disclose their remaining performance obligations, which is the revenue they expect to earn from existing contracts in the future. This forward-looking number is an impressive nearly $8 billion. That indicates a strong pipeline of future business. Here they discuss the fair value of their financial assets and liabilities. For things like certificates of deposit and credit facilities, they are using observable market data, which is a good sign of well-valued assets and liabilities. They also detail their lease agreements for office space and equipment. They have a good handle on their lease liabilities, which are their obligations to pay for these leased assets. Looking at debt, they have a 5-year senior unsecured credit agreement. They have about $20 million drawn on this facility. This is a relatively small amount of debt compared to their assets and revenue, which is a positive sign. They also had other lines of credit that were not utilized. Having access to credit lines without necessarily using them is a sign of financial flexibility. The company's effective tax rate is around 24.1%. This is pretty standard for a US company and has remained consistent. They also mentioned some tax law changes. While these things can sound complicated, it seems like Jack Henry is managing the tax implications effectively. This section deals with how they compensate employees with stock. They have incentive plans and awards. This is a common practice to align employees' interests with shareholders. The amount of expense related to this is also disclosed. We already touched on this, but it is worth noting that their earnings per share figures have shown consistent growth, which is exactly what investors look for. This is where they detail the acquisition of Victor Technologies Incorporated. As mentioned before, this was a strategic move to bolster their payments business. The acquired goodwill, which is the premium paid over the fair value of the net assets, is over $22 million. This implies they see significant future potential in Victor's business. The intangible assets acquired, like software and customer relationships, are also detailed. Here, they break down their business into 4 segments: core, payments, complementary, and corporate and other. The core segment provides the main banking software, payments handles transactions, complementary offers other services, and corporate and other covers hardware and unallocated costs. The payments segment revenue is over $231 million for the quarter, showing its growing importance. Looking at the overall revenue growth, they are seeing solid increases across the board. Services and support revenue increased by over 7% in the quarter, and processing revenue is up by over 9%. This is healthy growth across their main business areas. This is where we see how much it costs to run the business. Cost of revenue increased by 5.4%. Research and development is up by a modest 2.8%, showing they are investing in the future without overspending. Selling, general, and administrative expenses actually decreased by almost 13%, which is excellent cost control, especially with the timing of their Connect conference impacting travel expenses. Interest income and expense decreased. This is likely due to lower interest, earning balances, and credit line usage, indicating they are managing their balance sheet efficiently. The provision for income taxes increased, but this is expected given the higher income before taxes. The effective tax rate remains consistent. Ultimately, all of this translates to a strong net income growth of 27.4% for the quarter and a 23.8% increase for the 6-month period. Their diluted earnings per share also saw a healthy increase. Let's look at each segment presented. The core segment, their foundational business, saw revenue grow by 8.4%. The payment segment, a key growth area, increased revenue by 8%. Complementary businesses also saw strong revenue growth of 9.6%. Corporate and other revenue decreased, but this segment also includes costs. And the overall picture from the segments is positive. The company's cash decreased slightly, but they still have a healthy amount. They are generating significant cash from operations, which is the lifeblood of any business. They are investing in acquisitions, capital expenditures, and managing their debt and share buybacks. In this section, management discusses their performance. They state that technology spending by financial institutions remains strong, and there is clear demand for their solutions. They highlight their focus on culture, service, innovation, strategy, and execution as key drivers for continued growth. This sounds like a standard positive outlook, but the numbers seem to back it up. Scroll based on these numbers, Jack Henry and Associates Incorporated appears to be a very solid company. Their revenue is growing steadily, their profits are strong, and they are managing their expenses and debt effectively. The acquisition of Victor Technologies Incorporated shows a strategic focus on expanding their payments business, a market with significant potential. Their diversified revenue streams and strong client relationships provide a good foundation for continued success. The company is not without risks. However, reliance on technology and the competitive landscape in fintech are always factors, but overall, their financial health and strategic direction suggest a company that is well positioned for the future. They are effectively navigating the evolving financial technology landscape and delivering value to their stakeholders. This is a company that is growing and profitable, and the management seems to have a clear strategy. Alright, that is our deep dive into Jack Henry Incorporated's latest filing. What do you think about their performance and their strategic moves like the Victor acquisition? Share your thoughts in the comments below. If you found this breakdown helpful, give us a thumbs up. And make sure to subscribe for more corporate insights. And do not forget to join our Discord community for even more discussions. Thanks for watching, and we will see you in the next video.